Hi, welcome to the Financial Fox. We are back to reality after a long, hot British summer. I'm here with my usual sidekick, and I'm saying that in a nice way, the market guru Zach Meir and the machine the man Andrew Bell, chairman of Regency Mines. So Andrew, we interviewed you back in April, mainly to discuss the game-changing coal project in US. Now, I would like to grill you with a few questions that I've got from investors. So first of all, let's start with the infamous wholesale. Okay, so you have been selling off your shares in the project after getting a fantastic entry price. Now, investors are wondering, why are you selling off your shares if the project is so promising?
Well, we bought 5% of wholesale development early last year for £400,000. We bought it back, I should say, because we had previously been a shareholder, and we had the chance to sell, and all the transactions since have been considerably higher prices, and we thought in the interest of diversifying our assets a little, we'd sell a bit, and so we have sold 1.9% of that 5% to UK Oil and Gas, and in exchange we got some cash and we got some shares in UK Oil and Gas. £260,000 worth of shares at the price at which they were issued to us. Those shares in the last couple of months have risen to from 1.5p when we got them, and I think about 0.9 at the bottom, to the current price of about 8.5p. So we have sold part of those shares for £840,000, and the remaining shares were left with 6.8 million, are worth £700,000 or £800,000 as well.
So basically, even if the shares go to £10, you won't be embarrassed at having sold out at such a low price?
We still have, at the moment, 6.8 million shares in UK Oil and Gas, and that gives us exposure both to Broadford Bridge and to Horse Hill, and we have 3.1% of Horse Hill development itself. So we continue to have a substantial exposure. But as you can see from the prices which we've been able to sell, our exposure wasn't being recognized in our share price, and it represented a large part of our market capitalization, probably. And so by crystallizing some of that value, we benefit shareholders.
Yes, and particularly also one of the questions the investor asked me was the fact if you were going to use the cash and the money from the sale of the shares to clear your outstanding debt.
And we have indeed repaid 1/3 of the facility that we had already. And in addition, we are going to be subscribing another £400,000 for Caza Energy, which is coal bed methane in Oregon, as that moves towards listing in the next week or two. So we'll have 10% of that because we had an early pre-IPO investment, and we'll have a director on the board.
So you think that's, the IPO of Caza Energy, which look pretty exciting, do you think is going to have a good impact on Regency Mines share price?
Well, the potential of Caza Energy is enormous. I'll leave it to people to read the listing document when it gets listed. We've told people a little and had it in our presentations. The initial wells being drilled there only need to be completed and connected up to the pipeline, and the oil price in Oregon is a special market which has a substantial premium, fairly consistently about $1.50 over the Henry Hub price, which is the standard gas price in the United States. And there is a general move towards gas anyway, and we think that once these wells have proven themselves, that field, on which a lot of work was done before the company went bust in the downturn, has the potential for several hundred wells, and will make in the short term, we expect, but also in the long term, substantial profits from that investment.
I just wanted to ask a general question. You talked about how, even when you had the Horse Hill investment on your books, the share price didn't really respond. But you could say that the same thing about the whole of Regency Mines. I mean, it seems to be perennially undervalued. Is that because you seem to sort of flit from project to project, and there's no real rhyme nor reason from an outside point of view, from a private investor point of view, what you're actually doing, trying to get a couple of £100 here, a couple of £100 there, put a couple of £100 into a project. It seems to be a little bit, let's say, flaky.
Perhaps we've been too consistent compared with a lot of AIM companies, in that when we listed over 10 years ago, we said we were going to concentrate on base metals, and we have throughout our existence held copper and nickel exploration projects, and still do hold nickel exploration interests. It was a very substantial nickel cobalt project with a huge resource in Papua New Guinea, and nickel was the first metal to go up in 2004, and was the first to come down again, and has had a prolonged bear market, but is now showing signs of late recovery following some of the other metals. And the cobalt price, well, I don't need to tell you, it's performed really well this year.
Exactly. So, I mean, that's sort of like famous for being, just a fantastic, cobalt's fantastic this year. But, the Regency share price, again, is just like, people are loath to get enthusiastic about it. Is there any...
Yes, but I think our main asset was where assets were damaged by the particularly poor performance of the nickel price, which even among metals was a standout. And that's because of some technology developments by the Chinese as their demand for nickel expanded and the price went up against them, and some other factors. But the long-term demand for nickel, 65% of which goes into making stainless steel, is extremely good as populations industrialize and as middle classes grow. And so that will begin to come through, and in the long term it'll be a good investment. But for small AIM companies, having something that is long term a good investment, and that is a huge resource, one of the world's biggest, doesn't do you much good if it doesn't have present value, and if you go through multiple years where investors just aren't interested. So we were very faithful to what we took as our original remit, and only recently, when the oil and gas market really bottomed, we said this is the bottom. We predicted that the price would fall, it fell. We predicted that this was the bottom early last year, and we were getting into things like Horse Hill before, in anticipation of a secular trend of onshore development in the UK, and we reinforced our position in oil and gas markets at the bottom. And I think that would also apply to our coal investment, where we saw that there was also a bottoming in iron ore and coal prices at around the same time, and also the use of coal for power generation had become so unpopular, there was going to be some recovery in that as well.
Andrew, on your coal project, would you like maybe to update investors a little bit on La Rosa timeline?
Yes, so with this repositioning of Regency, which is designed both to create a earlier cash flow rather than having huge long-term projects, and oil and gas actually lends itself to that, because an exploration well can turn into a production well instead of the long cycle of development that hard rock projects habitually have. We also, so we move towards more cash generative projects, and I think some of the things we have been doing and are doing are generating cash, but we're also moving towards the energy sector, oil and gas and coal. The oil with Horse Hill, I think the story speaks for itself. We've been able to generate some profits as we go while retaining our base position in Horse Hill and the Weald. Coal bed methane, we've put a counter on the board, and we're in early pre-IPO in something that we think is going to be substantial and important. So and coal, we put our toe in the water and started on a strategy early this year. We got assets, we think, cheaply, but there was a lot of structuring work to be done with that, and it's a work in progress.
So it looks like you have got a plan now. So you just took out some money from Horse Hill. You are clearing your debt as well. Then you have got a new IPO and the call in US. Is there anything else that is exciting you are looking at? And
Yes, I think that what we're doing with the coal, it didn't go exactly as we planned at the beginning, as perhaps a first step wouldn't, which is why we did it fairly cautiously. We paid £250,000 for a 20% stake with no further liability in something where there was a commitment to bring it into production. We have since been offered terms to buy the whole of the rest of that project, but we'd had to do some due diligence to look at that. But what we recognized early on is that our partner in this and some other coal projects in the United States, where we got our toe in, didn't have the management capacity. So what we did is we came and introduced them to people who with management and financing capability, who also had the capacity and the vision of doing a roll-up with the objective of an NYSE listing, and restructuring all those interests with our partner, with the other partner that we brought in, and with the new producing assets that they are looking at, is taking time, as you'd expect, because it's been done in a very methodical way, because it's going to be financed in an institutional way, which of course has a much lower cost of capital. But with that much lower cost of capital goes a greater risk aversion and a greater professionalism. So we haven't been able to make announcements on that as frequently as we would like, because when you are negotiating with parties like that, you can't give progress reports on the negotiation. I think that stands to reason.
Right, Andrew, just the $64,000 question, which I'm hoping you'll answer, because it's just like trying to find out the meaning of life. How many billions of barrels of oil are under the Weald?
Well, I'm glad you asked me that, because when...
Are you sure you're glad that I asked you?
Yes, I am, because when this question was asked of people 2 or 3 years ago, they answered, and I think they were pretty much right, but that there wasn't the evidence at the time to support it. So it was a little bit...
I don't care about evidence, I just want to know what you think.
Well, what I think now is that the flow rates from the Kimmeridge horizons, which are the main oil-producing horizon in the North Sea, the flow rates from those horizons from the Horse Hill 1 well, in the very short tests within the time that they had the planning permission for, they produced really good results a couple of years ago. Some naysayers have been saying, oh, they drilled near the fault, and that's the only reason the structure was quite open and the oil was flowing. Well, now at Broadford Bridge, UCOG, which owns 100% of Broadford Bridge, is just starting extended flow tests at Broadford Bridge before going back and doing extended flow tests at Horse Hill. They've just got the last permission, the planning permission for that yesterday, and we'll get a stream of results. Now, if, as they expect, and as I expect, they get good flow results from Broadford Bridge, you can't use the same excuse, oh, it's a special factor, it's only a little area. You're going to reinterpret the whole of the Weald, and everyone will then see that there's billions and billions of barrels there, recoverable as well, and all these companies will get taken out by majors.
Yeah, but then the point is, you know, do you need to frack?
No, not if it's flowing. Not from the limestones.
Yeah, not from the limestone. Okay, Andrew, so lots of things to look forward to, and thank you very much for letting us to bombard you with the question, and I'll see you next time.
Thank you very much.